Thank you for joining us today for this webinar presented by the International Actuarial Association's Banking Working Group on Actuaries bringing value to banks by implementing IFRS. Some information for our listeners today. At the end of the session, we will be having a question and answer period. If you have any questions throughout the webinar, you can enter them by typing them in the Q&A box on your screen. I'll now hand over to Michael Tikareva, Chair of the Banking Working Group of the IAA. Michael?
To everyone who has joined this webinar. This is the second of a series of webinars that we planned over the next few years. Some of you who joined the previous webinar will remember it was in March, 29th of March this year, where we were talking about actuaries in banking and how some of the skills in traditional areas of actuarial practice are transferred and being utilized in banking. And today we are going to talk about IFRS9, its implementation. So there's going to be a background and its implementation, and we will end up on discussing the skills that are required for implementation of IFRS9. This is quite an important, these are quite important sessions because I would like to create CPD opportunities as well as sharing information with the actuarial community that's working in banking as well as just interested in banking. So I trust you enjoy. I would like to introduce you to our panelists. So we have got three speakers, Anya Bota, Christian Marini, and Matthew Walker. Then we have got a fourth person that you haven't seen, who is not going to be speaking initially. Maybe she will speak when we get to the answer to the question period. That's Kudzai Chigiji. She has been involved in putting all this together. So thank you very much. Then you also have got Christian Levac, who opened this session, who is supporting us from the IAA. Now, let's start with Anya. Anya is our first speaker. She has been working in banking for the past 11 years, where she qualified as an actuary. I know Anya for some time now, probably 8 years at least. She is an associate director at KPMG, working in the financial services space, focusing on credit risk. She's based in South Africa, but she does a lot of assignments outside South Africa itself. Her experience has involved all components of the credit risk cycle, of which impairment is one element. She will be sharing about IFRS9 experience, where she has been involved since the launch of the exposure draft on expected credit losses. Her experience has ranged from thought leadership, model development, and validation under both an audit and advisory function. That's Anya Bota. After we introduce everyone else, she is the one to speak first. Then our next speaker is Christian Marini. He is the head of Promotia IFRS9 development team, which is concerned with activities related to models, methodology, implementation, and IT software business requirements development. He has multi-years experience as international consultant in quantitative credit risk models projects within worldwide financial and non-financial institutions, mainly in accordance to the Basel II requirements. He leads teams that have executed and delivered various projects across retail, non-retail, and low default portfolios across different worldwide regions, such as West Europe, Eastern Europe, Russia, Turkey, as well as the MENA region. That's Christian from a company called Promotia. So he will introduce himself at a later stage when he speaks on his section. Then our last speaker is Matthew Walker. Matthew is based in South Africa and is an associate director in the Financial Services Advisory Division of Deloitte South Africa. He has over 11 years experience in the financial services industry, having worked both at a bank and in consulting. He has gained significant experience in IFRS9 having assisted many banks and other institutions with the development and the validation of IFRS9 models. He has been a fellow of the Institute and Faculty of Actuaries since 2010. Those are our three speakers, and so we are going to then hand over to our speakers. But before we do that, I'm just going to run you down on the agenda. So we're going to start with background on IFRS9, where Anya Bota is going to take us, and then we are going to have a section on the expected impact of IFRS9 on capital and provision, where both Anya and Matthew will take us through. Then we are going to move to how IFRS9 works, which Christian Marini is going to take us through. And then we are going to talk about the skills required and what's next, where we have Matthew Walker, who will take us through. And you still have Anya and Matthew, who will take us through on how will the skills developed in implementing IFRS9 be transferable to other industries and other parts of banking. So with that, I'm going to hand over to Anya, and you will hear me maybe at the question time. So over to you, Anya.
Awesome. Thank you very much, Michael. And thanks again for having me and giving me the opportunity to share a little around IFRS9, where I've been tasked to give you a brief introduction on IFRS9, touching on why it has come about and its interaction with IS39, which is the current reporting standard. If no one or if anyone has trouble hearing me, obviously just put a note down that I need to speak up. Otherwise, I don't know if your speakers are working. So during the webinar, I'll try answer any questions as I go, but if I don't get to your question, we'll have the Q&A session at the end of it, time allowing. And so during the whole phase of IFRS9, I hear a lot of my clients making the general comment that IFRS9 is only employed to give the financial services world something to do, and also to ensure the auditors remain in business. I do believe that there is a role for IFRS9, and it honestly presents an opportunity to improve an institution's fundamental risk management processes. So it's not only about the quantitative elements of providing, but it's also the qualitative elements and how all of these things stitch together. So IFRS9 was a response to the global financial crisis, where the crisis exposed the lack of foresight in provisioning under IS39. And also, if there's any jargon that I'm using that the listeners are not familiar with, please ask so I can elaborate what I'm actually talking about. So I'm going to be using provisioning and impairments quite loosely throughout my talk. But what the crisis exposed is also that the level of provisioning was a little too late, and these levels were raised, so too late, too little, too late. The other element uncovered was the lack of comparability between institutions, which also assisted in hiding the true risk that institutions were exposed to. And again, I'm using institutions because it doesn't only apply to banks, the standard. So I think later on we'll be touching on who is this going to be affecting. So IFRS9 is broken into three components, namely asset classification and measurement, which we'll refer to as CNM, the impairment methodology, and hedge accounting. I'll be mainly focusing on the first two elements, as hedge accounting is still in discussion. So the timeline on the slide in front of you doesn't really show how far back IFRS9 started, but the CNM portion of the standard was issued in November 2009, where it followed numerous consultations of the ISB with regulators, accounting bodies, as well as the G20 on both this portion of the standard, as well as bodies engaging in discussions on the way forward on provisioning. In 2012, the ISB developed the ECL model framework and performed limited revisions on the CNM sections, where into early 2012 and 2013, the first exposure drafts, both CNM and impairments, was issued. So after they were issued, the ISB wanted commentary from all institutions, regulatory bodies all over the world to finalize and tweak and answer any questions that the standard may have. The ISB then went through initial deliberations and updates. The final standard was issued in July 2014, where the current effective date for the standard is 1 January 2018, which is in a few months the standard will be implemented, especially for those institutions with December year ends. So moving on to the next slide, I will touch on the purpose of IFRS 9, followed by the main interactions between IFRS 9 and IAS 39. As I mentioned earlier, IFRS 9 is divided into three components or three phases. The first is asset classification and measurement, where this is a methodology used to classify assets which would determine and approach how to measure the impairment. So assets can be classified through fair value through profit and loss, amortized cost, and fair value through OCI or other comprehensive income. The standard also sets out guidance on how to allocate assets between these categories and what assessments should be performed to assess in which of the three categories the assets reside. I think Christian will be touching more on what this actually means. So the second phase of the standard is the impairment methodology, which basically describes how assets which are classified through amortized costs and fair value through OCI is measured. So impairments are important because they are the first layer of protection of losses for an institution. And the purpose of the standard is to combat the weaknesses of IAS 39. So IAS 39 is in essence an incurred loss model, and it's not an expected loss model. So under IAS 39, the higher level of impairment was only raised when objective evidence of impairment was identified. And to get to that level was very ambiguous. The impairment levels under IAS 39 didn't rise sharp enough to allow for the true losses that could arise if something happened, like, for example, the financial crisis. Institutions held too little provisions and raised them too late in order to cushion any losses or absorb any losses that could occur. So IAS 39 also doesn't consider future credit risk events such as either limit increases, so the fact that you're giving more money or allowing a lender to take on more risk is not considered. And also the likely drawdowns in future are also not considered. IAS 39 also doesn't consider leading indicators of risk, while under IFRS 9 losses would be identified quicker, and it also removed the requirement of observing objective evidence of impairment. The standard wants institutions to find triggers that already show the credit risk to have increased before it is observed, which under IAS 39, it doesn't. Sorry, my computer froze and I have to put my password. Apologies. There we go. So now the standard, or IFRS 9, is expecting us to hold higher levels of provisions already for when we've identified that there's been a deterioration in credit risk. This combats the too late component of IAS 39. The too little component has been tackled by raising lifetime losses for facilities that have already shown a deterioration in credit risk. The other element that IAS 39 didn't consider is it was based on historical data. That forward-looking information wasn't considered within modeling, so when adverse scenarios or the economy is in a downward trend, that knowledge isn't brought into your IAS 39 provisioning levels. And the other element is that IAS 39 also took advantage of doing assessments under fair value. So IFRS 9 aims to have institutions align their business as usual process to their accounting treatment, where in the past, the way business was run wasn't necessarily aligned to the way impairments were raised or how the financial statements were prepared. So there was a disconnect between the two. So under IFRS 9, the disclosure requirements have become more onerous, where all assumptions within the models, the approaches to CNM has to be disclosed, which is very different to what was done under IAS 39. And what most institutions are also not realizing is the extent of system development, the extent of system development to get these disclosures right. The standard also aims to bring all areas of business together and ensure that IFRS 9 integrates areas such as pricing, your budgeting, stress testing, regulatory capital, so that when you eventually giving a loan or onboarding a new client, all of these elements form part of that initial onboarding. So if you don't allow for lifetime losses or the lifetime expectation at origination, you can potentially burn through your margins and not make any money on the client. So you want to almost bring it in. And one of the other questions is, what is the impact of customers on IFRS 9, and will the cost be passed on to customers? So the standard does attempt to guide institutions to have a holistic risk management process and encourage collaboration and understanding of all key areas. It's a fantastic opportunity for actuaries to get involved, because they can be the link between business, risk, and finance, because we are skilled in breaking down complex problems and understanding the risk at each area and each point in the process, which is kind of what you've studied in the actuarial control cycle. So the next slide, I'm just going to briefly break down a bit more in terms of the impacts, where on average, we are expecting the provision impact to be between 15% and 50% between IAS39 and IFRS 9. So the EBA has released results for European banks in July, and on average, they've seen an increase of about 13% in provisions between IAS39 and IFRS 9. And what's important to note is this is a once-off impact. So depending how well you got this once-off impact right, the impact in future years may be less. The increase is very much dependent on the current way an institution is raising impairments. It's also dependent on a number of other factors, such as your current non-performing book, your target market and risk appetite, and also whether the bank itself is standardized or advanced. So, as I mentioned before, IAS39 is an incurred loss model, with a portion of the book that has not shown objective evidence of impairment, which is normally your 0 days in arrears. They utilized an emergence period. And that estimated the portion of the book that is likely to show objective evidence in the future before migrating into a loss state. So in simple terms, they would take your 12-month PD and multiply that PD by 3 over 12 factors, saying that it will take 3 months from some sort of trigger event to observe that there's a problem happening with an account. So you can see by removing that emergence period on its own, it's going to inflate your provisioning levels. So that is pretty much the first impact that I'm showing on the slides. The next impact I'm talking about is the lifetime expected credit losses, where instead of raising just a 12-month probability of default and loss associated with those defaults, we are now going to be raising lifetime losses for anybody that's deteriorated in credit risk. So there's a framework for you to move accounts from a stage 1 or to a stage 2, which means stage 2 is your deterioration in credit risk. And for these guys, we are now raising lifetime losses and not 12-month incurred losses. So this will allow for a steeper increase in provisions up to the point of default and avoids that last-minute increase in provisions once you hit default. So the next likely increase in provisions is the result of the inclusion of forward-looking. This could actually decrease provisions if your future expectation is great compared to what it is currently. But in most likelihood, on adoption of IFRS 9, we're likely to see a further impact on provisions. And what's also important to note is that forward-looking is not limited to only macroeconomic factors. It's also due to changes in operationalizing your business, such as improving your collection strategy or changes in your risk appetite where you restricting your lending to higher risk clients. You need to also build in that element into your expectations, because the data is unlikely to reflect that change of policy or process. One of the biggest impacts that we are seeing, and this is where business is primarily focused in your revolving facilities, is that now you need to allow for future likely drawdowns or your limit increases. So unlike your Basel regulatory capital models, your EAD was limited to the balance at the reporting date or capital date, and your balance couldn't be lower than this. IFRS 9 allows exposures to both be higher or lower than the balance at reporting date. And another curious point that under IAS 39, provisions weren't raised for accounts with credit balances. Now, if you have a client that has a limit but has got a credit balance, you still have to raise an element of provision for these accounts, because upon default or entering into stage 3, it could be possible that this account or facility could draw down all of its credit balance and hit the limit, which would then expose the institution to significant credit risk. So, as I mentioned earlier, all of these impacts are expected to be once-off on transition. But what we're also going to see is probably more volatility year on year with the inclusion of IFRS 9, because they want the provisioning to be more point in time and more representative of what's actually going on in business. We also are expecting, maybe also mention another change to what regulators and what we've done in the past is that sovereign exposures now, especially, we cannot consider them zero risk, and we cannot associate them with a 0% loss, which is what has been done in the past. So even though the sovereign exposure doesn't account for a big portion of the book, now you're seeing provisions being raised on these, which is not what has been seen in the past. But on top of that, impairments are also likely to affect banks' capital adequacy and loss absorbency potential, where the same study by the EBA has seen CET1 ratios decrease on average by 45. And the impact between standardized banks and advanced banks is different, where we're likely to see a bigger impact on your standardized banks. So I'm going to hand over to Matthew. He'll touch on more of the capital impacts on IFRS 9. So Matthew, go for it.
Thank you, Anya. Christian, if we just go forward to the next slide. Great. So, so as Anya was mentioning, many institutions are still trying to finalize their models and approaches for IFRS 9. But it's clear that across the board, the impact is quite significant in that it will lead to increases in impairments. So as background for those not familiar with banking, banks generally recognize credit impairments to reflect the expected credit loss, and they hold capital to protect against unexpected losses. And the capital resources that they have at their disposal to do this are split into the common equity tier, or CET1 capital, which is basically made up of the share capital and retained earnings. Then there's additional tier 1 capital, which is generally things like hybrid debt instruments. And then there's tier 2 capital, which is mainly long-term subordinated debt. So as a result of the anticipated increase in impairments that we're going to see, many banks are going to end up suffering a decline in the regulatory capital. And as Anya mentioned, the EBA has done quite a significant study around that. And just on the tier 1 capital ratios, if I recall, the decline's up to about 7 to 9 basis points. And the tier 1 capital ratio being made up of the CET1 capital plus the additional tier 1 capital, all divided by the total risk-weighted assets that the bank has. And those risk-weighted assets essentially form the basis of the capital requirements of banks, the capital requirements being what's referred to there on the left-hand side of the slide. So hence the capital ratios, depending on the capital resources and the capital requirements. So these are essentially the two components that make up the capital ratios for banks. So how do the increased impairments result in the reduced regulatory capital? The key reason is that the rising impairments essentially end up consuming the capital resources that the banks have available. So it's easiest to understand if you consider the situation for standardized banks. So if we look at those capital resources on the right-hand portion of the slide, so ignoring tax, impairments generally have a 1-to-1 impact on tier 1 capital. And this is because the increase in impairments implies an equivalent decrease in the retained earnings. And although the regulations allow for some offsetting in the tier 2 capital layer, the net impact of this large impairment is always capital depleted. And it's important to understand that the Basel rules distinguish between specific impairments and the general impairments that banks need to hold. The specific impairments are the impairments that are held against defaulted loans, while the general impairments generally capture what we can refer to as the freely available impairments. And the reason the banks are allowed to add back the general impairment portion to the Tier 2 capital is because they do not arise from actual monetary losses. It is essentially just this general provision that they're holding. So now if we look at the capital requirements on the left, under the standardized approach, banks are allowed to remove specific impairments from the exposure value on which the capital requirements are calculated, and this is because the standardized capital requirements are based on unexpected losses only, as the impairments are designed to cover the expected losses. In general, the interaction of the impairments with the capital requirements is more complicated than with capital resources, but the key takeaway from all of this is that there's always going to be a negative impact on the capital for standardized banks. So the picture that we have there, that illustration, is referring to the situation of the capital resources for banks following the advanced internal ratings-based approach, where the one-year expected loss is referring to the Basel expected loss, and the stock of relevant impairment is referring to the accounting impairment or the accounting provision that banks hold. Typically, under IAS 39, the accounting provision would have been less than the one-year Basel expected loss, and then a bank would have needed to reduce their CET1 capital by the difference between the two. And now with IFRS 9 likely to result in the accounting provision exceeding the one-year expected loss, banks will be able to add back Tier 2 capital up to a ceiling of that 0.6% of their risk-weighted assets. Essentially, this is similar to the standardized approach, but it is slightly stricter. And because of the significant impact that IFRS 9 is going to be having on the capital of banks, the BCBS put together a pay for covering several transition options that are available to banks to soften the impacts of this capital knock. And since subsequent to that, many central banks around the world have been adopting versions of their proposals. Effectively, the simplest version is straight line between 3 to 5 years. So I think the capital implications can be quite challenging. It's something that, especially, I guess, if you don't have some of the background into banking, so I know there's quite a lot of terminology there that can be confusing or something that you're not familiar with. But I think the key takeaway is that it does have a significant impact on capital, and something that shareholders and all other kind of interested parties are watching quite closely to see how this impacts the banks. Thanks. Over to Christian to go into a bit more detail on the impairment process and methodology.
Christian, are you there? I can't hear Christian right now. Can someone else take this over?
Yeah, I can talk to some of the key points here, and then Christian, if you do come back, or if you can hear us, then just jump in if you can. So we're looking at the impairment portion. So Anya mentioned at the start the overall, IFRS 9 standard, picking up classification measurements, impairment, hedge accounting. Impairment obviously being the most significant, and the one certainly from a quantitative perspective that has the most interest. Under the loan loss provisioning, some of the key considerations there being the types of methodologies to consider, lifetime expected loss estimation, and the staging definition. So how you put guys into the different categories that arise from the new IFRS 9 standard, considering some of the data requirements, and I think the IT, and we can come back to some of the comments around the IT. So it's one of the key areas of the skill areas that have been required for the new IFRS 9 standard. If we just move forward from here.
Christian, are you there?
So
Christian?
look at,
Okay, go ahead.
sure. Yeah. So if we looked at if we go forward to the stage distribution, Christian, can we go forward to the next slide, stage distribution, so we can look at the different stages within the impairment model? Yeah, there we go. So stage one is the first stage. So this is where accounts essentially are performing, and you'd be holding a 12-month expected credit loss against them. There's a key decision point here is the shift from stage one to stage two. So once an account goes into stage two, you move from having a 12-month expected credit loss to having a lifetime expected credit loss. And that's really one of the most significant components of the IFRS9 standard. Interestingly, when the US GAAP adopts the CECL requirements in 2 years' time, they won't actually have a stage one and stage two separation like this. It will, their version of the standard will be on a full lifetime expected loss approach, and that's quite interesting because I think that was initially how the IFRS9 standard and ISB wanted to set out the standard. There were lots of pushbacks from the industry. A lot of pushback from the industry, and essentially they created this continuous jump between stage one and stage two, where you go from a 12-month lifetime loss, or a 12-month view of loss to a lifetime view of loss, and that creates quite a significant increase in impairment. But the downside of this is that it creates a lot of complexity in the modeling. So I guess between the significant increase in credit risk calculation and the forward-looking information component, those are really the two most difficult and challenging parts that all the banks and other institutions grapple with whilst implementing the standard. I think one of the interesting points on stage three is that so if we just from the comment block there, essentially a bank would only need to recognize losses on the net carrying amount. So they would take the gross carrying amount, subtracting off the specific impairments that they hold against that, and that would be the basis of what they would reflect in their account. Whereas on stage one and stage two, you'd be reflecting the gross value of the loans and showing
I just want to double check. Is Christian back now? No. Okay. It looks like we're having some audio problems with Christian. Might as well keep on going. Who wants to take it over?
Jump in, and I'm not going to talk. I'll let Matthew continue. But also the trick with the staging is how to define the migration from stage one to stage two. Normally, to go from stage one to two, the last possible point that you can move is once an account is 30 days past due. To move to stay between stage two and three, the last available point in time is your 90 days past due, unless there is evidence to show otherwise. To determine this threshold is quite tricky because you need to balance the accuracy of moving accounts across, as well as the volatility of future, as well as your physical transfer rate, because you want to limit the accounts that are moving back to between stage two and stage one. So you do see methodologies that use rating or notching approaches. You do see approaches that use a proxy for lifetime. The challenge also comes in that people or institutions didn't initially have a view at origination what your future lifetime expected credit losses could be. And the standard is requiring you to compare your lifetime expectation at origination to your lifetime expectation currently at reporting date, which has posed a big challenge for institutions, especially when you're considering long-term books or long tenor books, where a home loan that was originated 10 years ago the expectation potentially is very different to what you see now, but how do you quantify it and how do you allow for that already in the past, which is one of the challenges banks are considering. So this should result in trying to, in changing the pricing process, the application process, and from our discussion right in the beginning, it's trying to create an integrated risk management process. So I guess, Matthew, do you have anything else to add, or if Christian's back, maybe he can jump in?
Yeah, so I think if Christian's back, he can jump in. Otherwise, I think if we go forward, we can look at the example of the lifetime expected loss.
Cool. I'll mute myself.
Christian, are you back now?
I've spoken to Christian. He's having problems with audio in Italy. So I think you guys can proceed with the session. If he does jump in, I think we'll hear him.
Okay.
Great. So Christian, if we just move forward to the next slide. So what we have here is just a practical example of how you can do a lifetime expected loss calculation. So essentially, building up the cash flows and the probabilities of all the future intervals that you'd expect over the lifetime of a contract. So, for example, in the case of a home loan, something like 20 years, you would effectively be following this process for a full 20-year period, potentially on a month-to-month basis. So certainly the computational complexities of this can become quite complex when you have to consider the whole lifetime of a facility. So I mean, I guess without kind of delving into too much detail of the formulas, essentially the expected loss in each period is the probability of, you can split into the probability of a default occurring in that period and default occurs. In other words, if the PD event comes true, then you'd have a cash flow associated with that, which is generally the LGD, or the loss given default. And then 1 minus the PD is the probability that the default doesn't occur within that period. You'd multiply that by the cash flow you'd expect to receive if the account essentially meets its contractual terms, and you can sum that up over the entire life. And that's what the sigma formula on the right is showing, is the summation of all of those individual probabilities across the full lifetime of the loan would essentially get you back to the current present value. Just on the present value component, it's relatively straightforward in this impairments banking context, where you use the original effective interest rates of a loan. If you can't find the if, for example, an account gets restructured or there's some other modification that happens to a loan, then there's some other complexities around updating the interest rate so that you can look at an updated version of the original effective interest rate. But in 90% of the time, it's always just based on discounting using the discount rate that you had at the origination of the facility. So if we go forward from here, let's look at a little bit more of the detail on the individual parameters themselves. And I think Anya mentioned this right at the start as well, kind of looking at the different components and alluding to the fact that this is quite aligned to the way the Basel models work. So IFRS9 is essentially more related to Basel II than it was to the IS39 model that most banks had in place, where you've got a PD, an LGD, and an EAD component. So the PD is measuring the probability of events occurring. The LGD is the severity, effectively, once a loss event occurs. And then the exposure at default, the EAD, is measuring how the exposure changes from your current reporting date to the loss event date. So the EAD generally uses some CCF, otherwise known as a credit conversion factor approach, where you, based on historical data, would estimate what the difference is, or the change in balance is from the reporting date to that default date. LGD is, from a Basel perspective, generally those would have been calculated on a downturn basis, similar to EAD. But for impairment purposes, you wouldn't essentially want to apply any of those downturn or those negative scenario estimates specifically. You would generally want to have through the cycle views converted into future in time views. So we sometimes talk about point in time, and then through the cycle, and then almost the similar catchphrase for IFRS 9 is fit or future in time. So looking at the point in time approach, but looking at fitting that to each of those individual periods that would have in the future of the contract, and using all of those to kind of aggregate to what the total expected credit loss should be. So if we move moving on from there. So this one, I think we've probably looked at quite a lot of the detail of the modeling approach, and I think mindful of time, perhaps we should just skip forward a little bit. But I think we've gone through the key descriptions of the modeling process. So I think that we just to pick up what we have here. So looking at some of the, from a IFRS 9 implementation perspective, there's a couple of slides that we've gone into a bit of detail on that. So some of the key areas, the modeling and methodologies. So there's a lot of consideration around what type of approaches to be following. This is quite a challenge for most banks. Lots of guidance papers being released from the BCBS and from various other committees globally that have helped kind of structure the and support the interpretation of what the standard itself wanted. So quite a lot of work there, but I think given that we are in implementation, I think most large banks around the world have incorporated this sufficiently. I think an interesting point is around the data and IT architecture. So an area where there's been a requirement for a lot more collaboration between the different functions within an organization. So typically impairments in small institutions was primarily just run from a finance area. In larger banks, being run from finance and from risk departments, obviously the credit risk in particular. But IFRS 9 has
Hello, can you hear me? Is Christian here?
Yes, Christian,
Matt,
I can hear you. I think
it's Christian. I'm really very sorry. I just used the phone. I have no idea what happened. Just before the meeting, everything was working properly, and when I had to start talking, everything is collapsed. I don't know why. I'm very sorry for that to everybody. If you want, I can continue, but you are dealing perfectly as you like.
Yeah. No, so I think definitely, absolutely, please jump in. I think I think certainly between this and the next slide, I think there's definitely some information we'd appreciate your insights into.
Okay. I will. Okay. Let's. You can finish this. Then I come back to the previous slide that I want to add just a very quick comment, and then we can go further if you don't mind.
Yeah, 100%. Yeah, so I think an area that's interesting is just so we talk about the IT side. So there's a lot of complications around, or a lot more complications around IFRS 9 and the different systems and the levels of data it requires compared to what the previous standards had in place. So there has been quite a lot of challenge for banks in terms of firstly aligning the data and in some cases even trying to go back historically and obtain the data required to develop IFRS 9 models. And I think along with that, there's a requirement to have the correct IT infrastructures in place to support the model development and ultimately to support the model implementations and the model runs in future. Macroeconomic scenarios, so that's, I guess, in terms of data requirements, quite a challenging area where a lot of additional data was required. Large banks have been fortunate enough to have economics departments that they can rely on to obtain economic data. So the standard obviously requiring consideration of the forward-looking information within the ECL calculations. So typical information would be things like CPR, GDP, so in a complicated scenario, a bank would want to consider those types of economic factors and find the correlations between those and the underlying parameters, being the PD, the LGD, and the EAD, and either build those relationships into the model themselves, or at least make some sort of out-of-model adjustment based on those correlations to allow for the forward-looking information, so that they can project or to allow for the forward-looking view of those variables inside of the ECL calculation.
Okay. Okay. Thank you very much, Matt. Yeah, if you just get back to the previous slide very quickly, that's the point. All the complications that Matt was explaining actually are in order to, let's say, to cover the overall exercise of IFRS9, since the complication and in particular for the credit risk modeling are quite, I mean, the dimension is quite big, because when we talk about Basel II, so banks already capable to have risk parameter some structured and advanced enough to calculate the lifetime, let's say the expected loss in this way. But we have to deal with all kinds of banks, also smaller banks. So it's not a matter only of data, it's not a matter only of modeling, but it's a matter also of architecture of the overall system. So for this reason, banks had to find out a simplified approach, which as a shortcut of the standard Basel II expected loss calculation and application, so throughout PD, LGD, and EAD or CCS. And sometimes when that was not possible, we had also to deal with some judgmental approach, which was, let's say, something that is not fully based on the analytical approach. And if you go ahead of 2 slides, if we skip the one that Matt gratefully presented, and the complication is because it was said by Anya at the beginning that is a very good opportunity for the bank to put together knowledge, competence, and skill from different areas in banks, such as accounting, risk management, and business, of course. And this picture, which is a sort of simplification of the overall system, helps to understand this integration between areas. Because when we talk about measurement and classification and all the standard calculation of the amortized, I mean the effective interest rate and amortization of the loans is something related to accounting. When we talk about expected loss and all the complication and all the specification of the calculation with the integration of macroeconomic scenario and satellite model is something more related to risk management, and everything has to build up on a proper system. So the IT is behind any bank's application. So in order to develop these, and you can face the problem, as we said, using different approach, so an advanced approach like Basel II-like or something a little bit more simplified. Anyway, have to be structured in a way that fulfills the requirement of IFRS9. So if we go to the final slide of my part, the banks what had to face was our first application. Let's say that when I used to attend as a speaker, but also as attendees at the early stage of the IFRS9 implementation, the main problem for bank was to set up the overall framework. Actually, during last, let's say, conference on the matter, I saw that more or less, at least biggest bank can sort it out in a proper way. And after that, I saw big worries related to the impact. So that was also the beginning. But anyway, when you are reaching the point where your problem is not anymore the setup, but analyzing the result, that was the biggest worry during, let's say, the last year or let's say the last month. When they realized anyway that these impacts, in particular for some regions or for some banks, are not that huge, so they can at least manage it. Now what is happening is like a feeling that all the approximation in order to execute the exercise have to be fine-tuned, and and as final thing, also how to validate and audit all the, let's say, the models and the system that have been implemented in order to execute the exercise. So I could introduce myself at the beginning, but the message in general here, in particular for the, let's say for this, the main topic of IFRS9, which is the calculation of the impairment using this new approach, is the fact that actually I'm not an accountant. I'm not before the IFRS9, also my company was not involved in activity related to the accounting. And the fact that now is an important business for us, for myself as a consultant, it's because the integration of the risk management and the measurement used for the let's say the usual measurement used in the risk management are actually deeply inside this framework, and in a way that is even more complicated than before. So the opportunity that Tanya was mentioning before is a big opportunity for the bank, and is a challenge that has to be sorted out. So I don't have any additional comment. I'm very sorry, just that I couldn't participate from the very beginning, and I thank you a lot, Matt, for helping me in solve the problem and to comment my slides.
No problems, Christian. So yeah, so I think if we just look a little bit now, I think the last little bit just around, I guess, thinking about the skills required, how this affects the actuarial skill set, where the opportunities are for the actuarial profession, and then I think lastly looking at how we can transfer some of these skills to other parts of banking and possibly into other areas where actuaries work. So initially here, I think this probably touches on a little bit of what we saw earlier, but the quantitative areas, data and technology areas, risk management areas, and general strategy and project management, I think are some of the key areas where the skills have been required within IFRS9 model implementations, or just IFRS9 implementations more generally. And there's a little comment down there from a global banking survey, where half of the banks surveyed around the world admitted that they didn't feel like they had enough technical resources within their own institutions to to kind of carry out all the work that was required, and some of them didn't even think it was possible to go find the skills required in the rest of the market. So it has really been a challenge for the entire industry, but at the same time created opportunities for the likes of actuaries working in banking to to create some value and to make their mark. Just a few points under the quantitative aspects. I think there's some, for example, run-off triangles is a method that I think a lot of people certainly working in the general insurance industry would be quite familiar with. So interestingly, there are some kind of transitions between the methodologies that used in insurance, making their way into banking, but also some things that are quite unique to banking. I think one of the interesting areas that's quite unique in the banking space is the requirements to model from a base level. So coding in SAS or SQL are from a base coding level, not using the kind of pre-built packages from for example like a Profit or something where you potentially have the ability to point and click, and you don't necessarily have to really get involved in that detailed amount of coding. That's quite a strong area where people and quants generally, and actuaries working in banking, have developed quite a lot of skills. Econometric modeling is quite a useful point because it's an area where bringing in the forward-looking information, there's been considerations of model types that we haven't had to use before, work for people with economic backgrounds, but I think also an area with actuaries with a holistic holistic skill set have been able to add value. Data and technology is probably an area where actuaries aren't, I guess, the most prevalent in the industry. So there's obviously a large IT focus in this area. So an area where there no doubt has been a lot of need for upskilling, but potentially also an area where there's been a lot of reliance on other departments within the bank, primarily within the IT infrastructure areas. So risk management, I think certainly an area where actuaries have played a large role, and something where they can continue to play a large role within the banking industry. So I think risk management principles are something that all actuaries should be quite familiar with, and certainly there's a lot of validation work still to be done within the IFRS9 modeling space. So lots to still do there, and a lot of areas where I think actuaries can still make their mark and play a leading role in the industry. Generally, I think the strategy and project management goes without saying that any large project requires a good amount of project management, and I think that's a certain area. I think looking ahead to something like IFRS 17, where there will be some level for learnings. Target operating model design, I think that point is just quite useful to consider. How once the IFRS 9 model is implemented, how will the risk function and the finance function and IT function operate coherently going forward? And that's not something that we've necessarily had to think about a lot before, but I guess it's not necessarily IFRS 9 unique, but any large-scale project that can involve multiple departments of a large institution requires a lot of detailed design and development for those sorts of models to be able to be implemented successfully. So if we just go forward from there, so the last little bit that we wanted to leave you with is around the transfer of skills and where actuaries in the banking space could potentially still can add further value in banking, and then also thinking a little bit beyond that. So certainly in the when we talk about optimization for IFRS 9, there's still a lot to do, and this is similar to what happened when Basel was first implemented in banks. There's I think a lot of institutions might have started out with idealistic views of having seamless models integrated by the 1st of January 2018, and I think as we get closer to that implementation date, the realization has hit home that that's not really going to be feasible. So you get to some extent, some portfolios, sort of more minor portfolios, or some subtle areas of the standard that you haven't necessarily been considered in detail will need to be optimized in future. So there are some areas within the modeling space where that could be the case, but in particular around modeling, there can be a lot of leverage gained from taking IFRS 9 models and considering them back to the Basel modeling sphere, and considering if are there ways to potentially reduce the risk-weighted assets that the banks require, and to therefore to achieve some capital efficiency. Around process and governance, whilst the target operating models might be developed for going live 1 Jan 2018, there's certainly going to be a lot of room to streamline the existing processes and try and create some efficiencies between the way capital and impairments are run within organizations. And on the technology aspect, there have been from some software vendors, IFRS 9 specific software packages that have been developed, but there remains large opportunities to integrate the technologies across entire firms to ensure, I guess, a consistent view of data and a single source of truth across an organization, and to harmonize the processes between the various areas. So just a little bit broader than just those, the immediate IFRS 9 requirements. Stress testing, capital planning is an area which has a lot of overlap with the modeling that's been developed for IFRS 9. So considering that the forward-looking aspects and the economic elements, there's in fact going to be a lot of requirements specifically around bringing those types of considerations into the stress testing that banks are required to do. Loan approvals and pricing, given that banks now go on and develop these lifetime expected loss models and effectively been able to calculate in a life insurance context, we refer to the EV of a loan or a facility. There's opportunities to bring that into the way that they actually approve loans and the way they price loans right on initiation, and just generally using the additional information and insights gained through the process and from these models that have been developed to make better business decisions across the organization. I think just maybe 2 points that I thought from an IFRS 17 learning perspective. I think the one overall, and I think all of the fellow speakers that have been involved in IFRS 9 projects would attest to this, is that the sooner you start, the better. There's a lot of complexity within any of these large accounting standards, and the sooner organizations start tackling the issues the better they will be. And I think the one learning from banking in particular is to consider the data requirements and the technology capabilities of an organization very early in the process. Because if data doesn't exist and there's adjustments or enhancements required in technology or the infrastructure of an organization, those projects can generally take quite a lot of time. So in fact, you know, in 2 years' time, there could still potentially not be sufficient data historically going back, or the correct technology may not be in place for organizations to seamlessly implement something like IFRS 17. So that's certainly an area that one would want to start planning for as soon as possible.
Okay, thanks, Matt. I guess we can go to our question and answer period right now, if there's nothing else to add. So I'd ask anybody listening to the webinar right now, if you have any questions, please go ahead and type them out in our Q&A box, and our panelists will do their best to respond. So we'll take a few minutes and we'll just wait for some questions to come in. And in the meantime, we'll just wait a little bit. I don't know if anybody has anything else to add in the meantime.
I think just maybe to add to Matthew's point, because he finished off on data. And I think the element of data is great, but people don't realize that the system changes that need to be done are also quite significant. And yes, from a modeling area, we're not necessarily directly involved, but we'll also be informing what changes need to be made. The disclosure or the finance team will be also instructing what needs to be done. From a rating model perspective, they'll be, how can I say, also instructing what needs to be done in terms of development. And through my implementations, I've realized that there's only one IT unit, you know, so the issue comes in that you need to put in the change requests for the IT team or the technology team to be able to implement, test, validate everything that's going on. And they also only have a limited period to implement a number of changes. So without sufficient forethought or being proactive in terms of what needs to be implemented, institutions are also going to struggle to do it. So, for example, a key area is in South Africa, we're seeing that banks are suspending interest once an account is moved into default or stage 3, which could be 90 days, it could be at different points in time, but they suspend interest. And what that means is that you're basically not recognizing any interest during an account being in default, which is fine. But under stage 3 or IFRS9, they need you to recognize interest on a net basis and not suspending it 100%. And sometimes the systems do not allow for that. So then you have to start doing funny accounting to make sure that the accounting at least aligns to the standard, which is a complexity that people don't realize. So just my food for thought. But
okay, great. Thanks, Anya. We do have a few questions that have come in, but go ahead.
If I can add something with respect to what was saying by Anya, because it's very important also, for instance, in terms of pure risk modeling, in the sense that foundation banks did want to use their rating models, but since they are foundation, they don't have any value of LGD or CCF, but let's focus on LGD, for instance. And actually, we struggle a lot in helping our clients in developing the LGD, because they believe that actually the data required for the calculation of LGD, even though they are complicated, it's sort of feasible for the banks to provide this kind of data. However, they realized that it was feasible. That was feasible. It's fine, but anyway, we could sort out and we could execute the calculation of LGD with a lot of approximation because of the big gaps that they had in data. So I think that Anya is totally right when the bank shouldn't underestimate the data issue, in particular for some kind of specific calculation. As soon as you don't have in place these models and you don't start using this data to do something, this data will never be as expected, let's say.
Okay. All right. So I'll begin reading out some of the questions that have come in, and I'll ask anybody who wants to take a gander at responding to please go ahead, unmute yourselves, and respond. So the first one we have from Wilson Orero. What advice do you have for IFRS implementation in unrated economies, especially with respect to PD and LGD modeling? Who wants to tackle that one?
So maybe I can jump in on this one first. So I think working particularly across Africa, this is quite a consistent challenge. So one option that you do have when you're looking in the at least in the corporate space is to use data from the likes of a Moody's or an S&P or a GCD, which is the Global Credit Data Consortium. There's some challenges when you're trying to use data from external providers, in that the data is not necessarily always representative of the economies that you're considering. But that is essentially one. It's not a cheap approach. That there are some simplifications that can be considered on adoption, but I think any of the large audit firms would challenge a bank if they at least can't demonstrate they have put the systems in place to start storing and tracking their own internal data. So whilst you might get away with some simplifications on initial adoption, there needs to be some demonstration that you're going to be improving the processes going forward. Speaks a little bit to the next question as well, I think, in terms of the simplification, simplified approaches that are available. There's a group called the GPPC, which is the 6th largest audit firms in the world, and they've actually put together quite a useful couple of papers. And one of those papers actually specifies what the requirements would be for a sophisticated adoption, simplified adoption, and quite useful. It also kind of specifies what's not actually compliant. And it's important for any sort of small to medium bank to also consider and ensure that they are kind of meeting the minimum of the simplified approach, but not falling into the non-compliant approach.
Oh, can I jump in, Matt?
Yes.
Lovely. So I think I want to just also talk to the unrated economies. I don't believe necessarily that because you're unrated, and I think there was another question with regards to the size of institutions, but for a wholesale environment, majority of the big banks or advanced banks are already utilizing external information such as Moody's transition rate or a Moody's recovery study, and trying to form an argument as to why you can use it. So from a wholesale perspective, I believe there is information out there that you can use externally to be able to substantiate for your own internal information. The challenge would come is you haven't done this in the past, so who's going to do it? And who's going to have the necessary expertise to be able to do it correctly and to challenge it correctly? The other element is that apart from developing this thing, you also need to validate it. So who's going to be doing the validation and the back testing of these models? So the requirements of IFRS9 are actually quite big for smaller companies, and how do you allow for proportionality? So the auditors within each company or within each area would obviously look at that. So if you're one of the largest banks in the country, I don't think proportionality will apply from a local perspective, but it could apply from a global perspective. So I guess there needs to be elements of that. For a retail perspective, you know, I believe there is data. It may not be as detailed as you need it to be, but you could potentially use a transition approach. You can already consider your portfolio of defaults and what has happened to them. So you may not have extensive levels of data or 5 years of information, but you can start extracting what is on system already, because there needs to be some sort of way of giving a client a statement. So if there is a way to give a client a statement, that means there has to be underlying information to form that statement. The challenge comes, and I've seen this in my implementations, is it takes 3 to 4 months to extract any information, and if you don't start now, it's too late. And that kind of also talks to, in terms of methodologies and approaches, it depends on your portfolios, it depends on how data rich your portfolios are, because you can have corporates where you attract very risky accounts, so you'll have a lot of defaults. So those approaches can be more statistically based, while other approaches with no defaults are very much expert judgment based, where you have to prove the methodologies and assumptions made by external agencies are aligned to your own internal risk management processes in order to adopt them. Does maybe Christian want to jump in and say something as well?
Well, thank you very much. Actually, what you said is more or less what most of our clients are doing. So when we talk about unrated, if we talk about like low default portfolio, like large corporate, or even financial institution or sovereign, they try to get information from the market, from the rating agency, for both PD and LGD as well. When we talk about unrated clients, because I don't know, maybe the IRB doesn't cover some specific portfolio, they will try to retrieve from historical internal data that maybe are not 5 years but maybe shorter, some measurement in terms of default rates or loss rates. So I think we are more or less aligned in this sense, and this is what the system and the industry is going, I mean the direction that is taking the system as well.
I think also what's important is, and I know me and Matt are from a audit background, but when you start making simplifying assumptions within the institution, because you do consider yourself small or medium, you need to get your auditors involved upfront, because you don't want a situation where they do not agree with your approach and make you hold additional provisions because the assumptions not aligned to their thinking or what they've seen or their experience. So I think it's quite important where if you are a developer implementing IFRS9, get your auditors involved upfront to at least review the principles that you're using to make sure that any simplifying assumptions you're using. I think there's always merit, so from Conrad, to use simplifying assumptions, but it always depends how you validate and support your simplifying assumptions and what proofs have you got to actually support it. If the argument is, but I don't have information, then the next step is when will you get that information to make a better assumption or to support your statement. So what I've always said to everyone I talk to is, if you can support your assumption, then I can't argue with you. If you show me there's nothing else better, I also can't argue with you, because you are the best person to know your own business. So I think that kind of, I think, hopefully answers Conrad's question. Does anyone else want to add anything to that? All right, so let's then move on to the next question, where we mentioned that IFRS9 will make banks more comparable, but will the subjectivity and how macros are forecasted not make the comparability of IFRS9 provisions between banks very subjective or difficult? And I guess this is, and from our experience in the Reserve Bank, this is quite a difficult topic, because our Reserve Bank at a stage was trying to force the audit firms to have their own opinions or their own house view of what the economy is likely to do in future. and to impose or challenge the banks and macro institutions of why they believe theirs is right compared to ours, which would then open a huge can of worms, because the economists, no two economists can ever agree. So I think, yes, in terms of it will make it difficult, but I believe that in terms of disclosing it, you would need to disclose it to enhance that comparability of what's going on. And this also aligns to your budgeting processes. So if you're not using, macro factors that are linked to what you expect to happen in future, then theoretically you're also missing the point. So the IFRS9 in my world, I don't think is going to make the stakeholder or shareholders or analysts understand it any better than IS39, even though that's what the standard is trying to achieve. Because the complexity and the components and the moving parts of IFRS9 alone are going to cause utter confusion, especially when the first disclosures come out.
I would like just to add a comment in this sense, because actually it's correct. If we want to be comparable, but then your inputs are different, so for some reason then the comparability assumption is like it's spoiled. Anyway, in Europe next year we have for the biggest European bank, we have the European-wide stress test asked by the EBA, so the European Bank Authority. And in this exercise, which is included also the IFRS9 exercise, the guidelines, the European Bank Authority guidelines propose also a standard scenario, actually two scenarios, one adverse and one baseline. And I think that many banks, at least for the first application, they will also try to see the outcome coming from these scenarios. So I agree that is a question mark, still a question mark, but I think that little by little also local regulator, not only in Europe, will try to find out a solution to make it sort of comparable, in the sense that also the scenario will be provided by somebody, at least arrange something like that.
I think also, J8, sorry, that SARB will make macro forecasts in future. I think you've got two chances, and one of them is when pigs fly, to be honest. I don't believe regulators will do that, because then in essence you are forcing everybody to have the same view, which, you kind of then manipulating the economy in a way. So I think everyone should have their own views, but what we are going to probably see is the auditors will need to have a consistent view, or, no, well, maybe not a consistent view, but where it's going is you'll get this industry standard statement all the time, which will then make approaches converge, like we've seen with Basel, where, with migration of people between institutions, you'll see your modeling approaches are starting to align more and more and more as IFRS9 develops better. So I'm just going to also talk to Ibrahim. Do financial institutions are to hire on actuaries on staff, or can independent consulting actuaries provide their service? Does anyone want to take that? Matt, Christian?
So I can jump in maybe on this one.
Not really. I mean, please go ahead.
Sure. So in the South African market, I think there is quite a large presence of actuaries working in banks. And yes, so absolutely, banks. There's nothing to stop banks hiring actuaries, and obviously working either as independent contractors or through consulting firms. There's a large amount of work in the market. There has been around IFRS9, and there will be in the future as well. I think what makes the South African market quite attractive to the South African banking market, what makes that attractive to actuaries, I think, is also that there's a general recognition for actuarial support in the South African market. So I think what the biggest challenge to any firm wanting to hire actuaries is, will they be able to give the actual students the same kind of study support? Because otherwise, on a like-for-like basis. You're not really it's not likely you're going to get many actuaries wanting to join a bank if they don't get that. Obviously, then once you're a qualified actuary, then maybe it's a bit of an easier bridge to kind of cross. But generally, I think that's one of the kind of the key differences that we've seen in South African market.
So I'm going to maybe pose, so Richard has asked a question on the panelist discussions. One of his first question, and maybe I'll throw this at Matt, just because you touched on the capital side, but I can jump in after if you need. So he says it's clear that banks will need to reconsider their credit risk appetite and the capital that goes with this. How do you envision this would reduce the amount of funding available in the market for commercial and retail perspectives? Specifically, how do you envision this would affect funding available to SMEs in an emerging market such as South Africa, where economic growth and thus job creation will come significantly from the same space?
Yeah, so I guess that's quite a detailed question, and one that I don't think necessarily we can have a definitive answer to yet. So it does. I mean, so it's to the extent that it will affect, banks giving out loans. And, it depends on how much of that forward-looking and how much of the complexity they're going to be bringing into their pricing and loan approval process. So it won't necessarily imply that you're going to be providing less credit to the market. It just means potentially that they would be not recognizing the profit up front as much as they would have previously. Ultimately, IFRS 9 doesn't change your final loss profile. It just means that you would be holding higher provisions in that first 12, for that first 12-month period. So generally, that would just imply that there is less profitability, but it doesn't make lending unprofitable.
So also, I think it feels very dramatic to me a little bit, where, I don't think it's going to reduce the amount of, how can I say, loans to SMEs or reduce funding to higher risk clients. Because I think if you're pricing for that risk accurately and making sure, and unfortunately in South Africa, and I'm not sure in the rest of the world, but we do charge our higher risk clients higher interest rates, which they can't afford, which they then go to microfinances who want to break their knees eventually when they don't pay because they're being extorted. But that's a separate issue that we're having. But I think the cost will have to go to the customer. Unfortunately, majority of regulatory costs do eventually go back to the client, which is unfortunately the case. I guess the shareholders will also have to bear a bit of the cost with the reduction in retained earnings and all that stuff. So I guess I don't think business will change significantly because IFRS 9. I think it will change the way in which we price and in which we lend, from being able to know who you want to lend to and being able to identify that risk up front and whether you're willing to accept it. So I guess if you're making money and you're making sure you can recoup and the shareholders are happy, I guess it doesn't really matter much. Well, maybe. So I think let's then tackle part 2. I know we have 5 minutes left. And I don't know if I can answer this question. So how would this play out for investment bank relationship managers and front office bankers where their current remuneration system does not allow for significant P&L volatility that comes with clients or credit facilities migrating to stage 2? Christian, do you want to add any value there?
Not really. I mean, with respect to this point, I was thinking about the fact that the real impact in terms of loan price is going to be for the highest risk clients because they have to. I mean, the bank have to bear with the lifetime expected loss, and I was always. Curious about how the banks face this problem, and what do you think in case a parallel market of stage 2 clients, because actually the staging criteria is defined based on the origination. So some clients, which is high risk, for some bank can be a stage 2 because the origination was done when they were working very well, I mean when the risk was very low, and they became a stage 2. And so for some other bank, if they they originate a loan, actually they are in stage 1, so they don't suffer this significant increase of risk. So I was thinking about this loan pricing with respect to the possibility to have a sort of market where the banks sell to each other loans, so which are stage 1, in stage 1, I mean stage 1 or stage 2. And because this is actually also something that it's going to be the consequence of this framework, and it's going to impact on the system in terms of pricing and risk, so credit policy and risk appetite framework as well. I don't know if I was clear in what I was saying.
Yeah.
So anyway, specifically for your question, I don't have much comment. It's just something that I was thinking about.
Yeah, I guess P&L volatility, we need to reduce P&L volatility, which then encourages you to price correctly up front and to be careful about how you assess risk. So if you get it right, which is not hugely likely, but it will allow the bankers to actually pay attention to who they're lending to and to be able to actually do their proper due diligence to make sure that they are writing good risks. So yes, there will be volatility, but if your transfer rates or staging criteria shows that your rollback rates are relatively reduced and there's not a huge volatility between stage 1, 2, and 3, then you've got it right, and then you're not expected to see that huge volatility. So it all depends, in my mind.
Okay. Have we covered all the questions now, I think?
I think there was one question regarding recommendations for determining SICL, for determining increasing credit risk. Perhaps we can just briefly touch on that one. So if you go to the purest version of the standard, it requires that you look at the change between the origination point and the latest reporting point, considering the change in the credit risk at a customer level between those 2 points. So to the extent that you can track application or behavioral scores, then that would be the best alternative to compare the risk between the 2 points. But alternatively, if you're not using such a detailed measure, the kind of the quick way to do it is to consider the list of backstops, and that's quite a common method that banks are using where they don't have the sophisticated scorecard methodologies. The only other component there is to link it into a pricing model and to consider how your pricing decisions would change between your origination point and your latest reporting point.
Yeah, actually it depends on the complexity of your rating system. Of course, if you are able to calculate the cumulative PD at origination, since origination, and you can compare with the current one, it would be most probably the most advanced approach. Of course, at least for the first application, or for the first year of application, I think that the majority of banks are not able to track this, at least to compare these two quantities, and so they can use even the oldest PD, considering the current PD model, so anchor points and calibration points and methodology that they use, and they try to compare these two quantities, but most probably this is not enough. This is not enough because actually you cannot go far in the past. the regulatory, like 30 days past due as a backstop, it can be a solution. And some local banking system are focusing only on these approaches. But of course, everything depends on the complexity and the capability and the maturity of the credit risk models in place in the banks.
All right. I think we've run out of time.
Yeah, I believe.
Yeah.
Yeah.
Do you still have any question? Because we have. Okay.
Yeah. Go ahead.
All right. So look, I would like to thank our panelists for giving us insight into IFRS 9. That's Christian, Ania, and Matthew. And I would also like to thank Kuzai for putting all this together, running around, and Christian for also helping us put all this together. That is the other Christian. And I would like participants. And what I hope is that at least this has given a very good overview and insight into IFRS 9. And for me, the most important takeout here is we saying as actuaries, there is a role to play. There is something we can give in this space, and it has been happening. So it's an opportunity to use our skills in order to develop this new practice area of banking. And Christian Marini is very experienced, not necessarily an actuary, but what he has highlighted here, you can see that we are speaking exactly the same language. So effectively, as actuaries, there is a lot to do in this particular space and most other areas of banking, and that's what we're trying to show in these webinars as we go along. So thank you very much. I would hand over back to Christian to close, and then hopefully we will speak again in the new year when we have another banking webinar.
Thank you, Michael. I just wanted to add one small point. There was a question about the slides. Actually, the presentation and the slide presentation and the recording of this webinar will be available on the IA website by the end of the day. So if you manage to get on but you missed parts of it, you can listen to it again, or you can go ahead and take care of the slides as well. So I'll close this off, and thank you very much for participating today. Thank you.
Thank you.
Thank you very much.